let me bring in Dhirendra Kumar, the CEO of Value Research and the expert who answers our mutual fund questions. Dhirendra, thank you so much for joining us on Investor's Guide. Let's get straight to our portfolio versus portfolio segment. Rohit has written in, he's 41 years old and he's been serving the Indian Army for the last 17 years with an annual income currently of 11 lakh rupees. Now he also has a young son who he wants to plan for. Now Rohit has sent in his list of investments. Dhirendra, he puts 5,000 rupees every month in a bank recurring deposit, and that amount currently stands at about 40,000 rupees. He also has 10,000 rupees per month going into his Provident Fund. Now that's a lot of debt investments for someone his age. He's invested in a few insurance policies as well, and he's unhappy with the performance. Now, first of all, like all army officers, he has the army group insurance that covers him for about 40 lakh rupees. He has an LIC policy, which is a term plan for a cover of 6 lakh. But, Rohit, it seems like that term plan is really expensive if you're paying 7,000 rupees for a 6 lakh cover. Currently, the new term plans are available for far cheaper, so take a look around before you renew that particular policy. He also has a couple of ULIPs which he's been using to save for his son. He's unhappy with their performance. Now, he's also invested in a number of mutual funds. He wants to have about 85 lakh rupees, I beg your pardon, at the end of 10 to 15 years for his son. He's been investing in HDFC Top 200, IDFC Premier Equity Plan A, ICICI Focus Blue Chip, and a gold ETF. Now, this is the interesting part, Dhirendra. He plans to move into the private sector in 6 or 7 years, and he wants to know if his investments are sufficient. Now, first of all, your army policy will no longer cover you once you shift to the private sector. The lack of the term cover that he has, and also the amount that's going into equity, which doesn't seem to be enough. Would you think he'd need to relook at those ULIPs and figure out what he wants to do with them?
One is that, his specialist situation. In fact, the situation of all armed personnel is quite unique. That is why Army Group Insurance was created. War casualty is not generally covered by normal insurance, the insurance coverage which is available to individual investor. ULIPs might be an exception, but term cover is generally not available, and particularly group term was not available. That is why Army Group Insurance was created. So from that standpoint, I don't think he has a choice but to stick with Army Group Insurance. At the same time, that is not a negotiable thing. All officers get a coverage. That apart, I think, it's about time to, take a very hard look at all his ULIP policies. And normally ULIP policies, the way to exit is, you have to continue. All his ULIPs are old. You must invest for the first 3 years to avoid forfeiture of the money, and then must continue, must hold it for another 2 years. Otherwise, the surrender charges are very high, and then consider exiting. His mutual fund investment is on track, is of a high quality kind. I would suggest that, he can well consider exiting his, stopping his recurring deposit, and whatever is the accumulation in the recurring deposit should think of it as a contingency fund, make a fixed deposit of it. So on an overall basis, his asset allocation remains looks like a balanced fund, a third of it going into Provident Fund, and he should be fully invested into equity, the rest of it.
Right, and if you look at his mutual funds, he has very good funds right now, but when you look at his portfolio and his term horizon, are you happy with the mutual fund selection that he has, or would you like to change something?
I don't see the role for the gold fund, but it could be a matter of personal preference or choice, or just fascinated by the recent performance. He should think in terms of keeping a very marginal exposure to this, and all the incremental money of the RD, as well as and when he's able to discontinue his ULIPs. He should think of, just building on this portfolio and increase the amount proportionately.
Stop investing or any more money in the ULIPs that you have, but don't pull that money out unless you get a very clear idea of how much money you will get back. So you might have to leave it in for a few years just so you can break even, just so those charges tend to even out, and then wait for the market to recover a little bit as well before you decide to pull that money out of a ULIP. You have to be very careful about that decision, but stay with the funds that you have. Dhirendra says it should serve you well in the long term. Right back to us if you need anything else. Let's move on now to our hold or sell segment. Rajesh has written in, he's 29 years old with a monthly income of 42,000 rupees. Now, he has health insurance and life insurance. He also has a family member who's dependent on him. Now, he's been investing 10,000 rupees every month in mutual funds, and he wants to know if his investments are on the right track. Now, I'm going to take his balanced funds first because he seems to have 3 balanced funds in one portfolio. He has the DSP BlackRock Balanced, HDFC Balanced and HDFC Prudence. Dhirendra, for someone who's that young, would you recommend he has these many balanced funds in his portfolio?
Given that, he has a lot of time in hand, being 29-year-old and rest of the things being covered well, it'll do well to, take a very objective look at what he's trying to achieve and how to achieve the diversification, how to achieve. One is choosing good fund, but having too many of good fund may not necessarily be good.
So would you recommend then that he hangs on to the 3 balanced funds? For
a 29-year-old, I don't see a role for the balanced fund, given that, the EPF contribution will be into fixed income. He still has nothing on the horizon.
The next fund on his list is the DSP BlackRock Top 100. This is also a very strong fund. Dhirendra, continue investing in this one?
Yeah, what I would suggest is that, DSP Top 100 is a good fund, but may not be best fit.
HDFC Top 200, which is the next on his list, would possibly fall into that same category?
Yeah, exactly. I would, I would like this portfolio to be mapped to one of our portfolios, where he will gain diversification of across asset class, across style, maybe our growth portfolio. And that will also reduce the fixed income allocation which he is getting by virtue of owning these 3 balanced funds.
Moving on to the DSP BlackRock World Mining Fund, does he need this kind of exposure? Does someone of his age who's watching, do they need exposure to a fund like this one?
No, I would suggest that, one should stay away from such fund unless one has some specialist understanding or belief in such a concept.
Reliance Equity Opportunities is the next on his list. Continue investing in this one?
No, this is an impressive fund, and so were many other funds, like all the balanced funds, as is, HDFC Top 200, which is part of many of our portfolio, or DSP BlackRock Top 100, which is also, a recommended fund on many occasions. On that front, Reliance Equity Opportunity is a fairly impressive fund, even now, and can be held.
Finally, Reliance Gold Savings Fund, should you continue investing in this one?
There are 2-3 reasons why gold should be there in a portfolio. One is that your savings in a gold fund, and you plan to replace it, substitute it with real gold at some point. So it is more of a savings vehicle in gold. If that is the goal, then continue investing it. The other reason why one should have gold is to try and ride the gold boom which we have seen over the past 4 years, and get out of it as and when you think that it might be over or you have got what you expected. Gold over a long period of time has not been able to beat inflation. It's better to keep away from it if it's part of if you have bought that particular hypothesis.
Best suited for your needs would be our growth portfolio. Our growth portfolio is on your screen right now. Ideally, you should be switching to this portfolio. Alternatively, he has told you what you should and should not hang on to within the ones that you have right now. We have one more question that's come in from Indrameet. He writes in saying he's been regularly investing in mutual funds, but since the interest rates have peaked, he wants to know, should he start investing in debt instruments? Now, he wants to know the difference between a gilt fund and a dynamic bond fund.
Gilt fund, they invest entirely in government security. And because government security comes with very long maturity as well, so the fund manager is has the advantage of moving very long as and when he finds opportune. And if, the consensus is built around a rate cut, and from that standpoint, gilt funds do very well in such a period. The other one, the dynamic bond fund, they have the flexibility of being into corporate debt, and if it is, or being into government security, they can be all over. It's virtually, a go anywhere fund in the fixed income framework. I would say that, there could be good times ahead for fixed income fund, and gilt funds tend to be a little more volatile. They can also be disappointing, though the consensus is built, but one never knows when it will happen and when you will start benefiting. So if you are prepared for the volatility, be into a gilt fund, and if you are planning to hold it. If you want a less volatile way to ride the rate cuts, then be into a dynamic fund.